Critical Man Pictures presents the 5-Minute Forex video trading series, How Forex Works. What is traded in Forex? The simple answer is money. Because you are not buying anything physical, this kind of trading can be confusing. Think of buying a currency as like buying a share of a country, similarly to buying stocks is of a company. The price of a currency is a direct reflection of what the market thinks of the current and future health of a particular economy. When you buy, say, the Japanese yen, you are essentially buying a share in the Japanese economy. You are betting that the Japanese economy is doing well and will even get better as time goes on. Once you sell those shares back to the market, hopefully you will end up with a profit. In general, the exchange rate of a currency compared to other currencies is a reflection of that country's economy compared to other countries' economies. Currency symbols are identified by the first two letters being the country, and the last letter identifies the name of the currency. In the two examples below, you can see how the US dollar and Japanese yen are identified in Forex trading. Currencies are priced by the following conditions. Political conditions. The stability or instability of a country or region has a direct reflection in how the rest of the world views both the country and their currency. Economic conditions. Economic conditions means two things: GDP and unemployment rate. If the GDP of a country is at record levels, then investors will be looking to that country to invest. Similarly, if the unemployment rates are low, then it means that the economy is stable, moving forward, and it'll also attract investors to the country. When a country experiences money flowing into it from investors, it pushes the value of the currency up. Using a generalization, if a country has a low employment rate and high GDP figures, then the currency will be strong. Interest rates. Interest rates is basically the price of money, how much you pay for money. If you want to borrow money, then this is the price you will pay. Interest rates play a major role in currencies. Global trade. An interesting tidbit for you. In 2003, Chrysler, one of the Detroit Big Three automotive makers, made more money in the Forex market than they did selling cars. It pays to understand the big chunk of the Forex market. It pays to understand the fluctuations in the Forex market for any economic professional, especially those that have operations all over the globe, because they can hedge against fluctuations of currencies or even trade to make a profit. Central bank intervention. Central banks control the interest rates of their currency, and many nations have slashed interest rates to record or near record lows. Central banks also pump liquidity into markets to keep the credit flowing. An example of this: let's say your country's currency is very high, very strong. It would be very difficult for you to export your goods because other countries cannot afford to be able to pay you for your goods. So central banks will step in to force the value of your currency down. One way is by slashing interest rates, forcing the price down so that making exports easier. One unfortunate byproduct of this is it makes imports more expensive for your citizens. Central banks have to find a delicate point to balance monetary policies.